The FIRE movement is a trend amongst young workers which is growing in popularity thanks to its very enticing goal, which is spelled out right there in the name. FIRE is an acronym for Financial Independence and Retiring Early. The idea is that by following a very aggressive saving and investing strategy, people can get to a point where they're retired at a very young age, sometimes younger than 30. In a world where we are being told that pensions are running dry and the average person may have to work in some capacity for their entire life, this sounds like a bit of a lofty dream. Sure, there are trust fund babies and young tech bros who may earn millions within their first few years in the real world, but surely kicking back on a beach and never thinking about work again is not attainable for a regular wage slave, right? Well, if some figureheads and internet forums are to be believed, well, yeah. Actually, it is pretty much attainable for anybody. Now, in the interest of full disclosure, I am a passionate advocate for the financial independence movement, but that does not mean that I don't see issues with it. Now, many of those issues are glossed over in the sheer simplicity of it, which is also part of the reason why it is so powerful. So long as someone can get to a point where their investments are making as much as their living expenses long term, they have achieved financial independence. Simple as that. Getting to that point is harder for some than for others, but advocates of the movement argue that this difficulty has more to do with personal lifestyles rather than personal incomes. So, what are the mechanics of the FIRE movement? How could someone use it to stop working forever? Is this actually attainable for anybody like they say? And finally, what would this movement do to the wider economy? If everyone strives towards a goal where they quit working at the age of 30, surely this would bring our world to a grinding halt, right? Well, if we can properly explore and answer these questions, we will be able to reveal if this whole thing is grounded in reality, or if it's just a fanciful pipe dream from people who really hate their boss. This episode of Economics Explained was made possible by our mates at Acorns, the app that simplifies all your financial needs. Checking, saving, investing, retirement, and much more, all in one. Stay tuned until the end to learn more, or sign up now at acorns.com/EE, and Acorns will deposit $5 into your portfolio to help you get started with investing. The link is on the screen now and in the video description below. Now, if you are thinking to yourself that the idea of retiring at the age of 30 sounds pretty compelling, the first thing you need to do is really understand how this system works. So, outside of broad statements like saving and investing, what are the nuts and bolts of FIRE? There are historical figures for a range of very important factors in the economy, which helps us in a sense make projections into the future. The assumptions that are relevant to the idea of FIRE are that a well-diversified investment portfolio should return around 8% per year, and that inflation is around 2 to 3% per year. Some of these figures can change, but with this, we get the foundation of being able to live forever off your investment portfolio. For example, if you had $1 million invested into a broad market index fund, you would normally expect that over time, the returns from this portfolio would average out to about 8% per year. And for the last 100 years or so, that has been correct, on average. This return would be split up between dividends and capital appreciation. In other words, the rise in price of stocks within the index. What this means is that effectively you would be able to draw $80,000 from this portfolio every year, and it would still be worth $1 million. Now, $80,000 is a pretty comfortable lifestyle for most people in most cities around the world. And while saving $1 million is obviously hugely difficult, it's not impossible for people with good professional careers, especially if we are looking at dual income households. But there are two factors that make this a little bit more difficult than it would initially seem. The first is that inflation rate. The Federal Reserve Bank of the United States targets a 2% inflation rate. In 1960, the equivalent of an $80,000 salary today was around $5,600 per year. Since the FIRE movement is all about retiring at a very young age and enjoying a long life without the need to work, you should realistically be planning for at least the next 50 years. At a 2% rate of inflation in 50 years' time, that $80,000 a year salary that you are pulling from your investment portfolio would only be the equivalent of a $32,000 salary today. I mean, you could still scrape by in a low cost of living area in the United States, but it would be far from comfortable and it might put you in a position where you need to go back to work at the age of 70 after 40 years out of the workforce. Good luck. What that means is that for this $1 million portfolio to maintain its real value, you would need to put back in $20,000 per year to fend off that 2% inflation rate. Not a huge deal, but what that means is that now you are only left with $60,000 a year to live on. Beyond that, some people want a bit of a buffer in their investment growth, so it's normally suggested to reinvest at least 3% back into your portfolio year on year. Alright, so now all of a sudden we are living on $50,000 per year for the rest of our lives, and this is before we get to problem 2. There is a strategy in investing called dollar cost averaging, and it is a really powerful thing to understand. The idea is that the market is erratic and mostly unpredictable, but over time it trends upwards. So, if you consistently invest at a set time interval, like let's say once per month, you are going to get the most out of the market for 3 reasons. Reason 1 is that it takes the emotion out of investing. If you automatically set money aside and don't think about it, you aren't going to be tempted to buy into the next hot stock or pull your money out at the bottom of the market. Reason 2 is that it gets your money to work right away. If you hold off from investing for a year until you have done some research on a particular stock or whatever, you will be missing time in the market to generate returns. Since on average the market returns 8% per year, if you hold off investing $10,000, you would already be $800 behind someone who is just dollar cost averaging. Time in the market beats timing the market, as it were. Now the third reason is the most powerful and also the hardest to understand. The key to investing is buying low and selling high, right? Well, by investing at set intervals, you're kind of doing this by default, which sounds weird, but let me explain. If, for example, you invest $1,000 a month into Walmart stock, it would depend on the price of the shares as to how much stock you actually buy. For example, if it is trading at $100 per share, you would be able to buy 10 shares. Simple enough. But now let's say the price doubles to $200 per share. Well, at that price, your $1,000 a month investment is only going to buy 5 shares, and the same is true if the price drops to $50 per share, where suddenly you're going to be able to buy 20 shares per month. By maintaining a consistent investment pattern, this hypothetical investor has bought more shares when they are cheaper and less shares when they are more expensive, giving them a win in at least one side of this buy low and sell high debate. The problem with all of these benefits of dollar cost averaging on the buy side is that they are the same as the drawbacks on the sell side. If someone is drawing $5,000 per month from their portfolio to maintain their living expenses, then they are naturally going to sell more of their shares when they are cheaper than when they are more expensive. For all of these reasons, most people in the FIRE community work around the 3% rule. This rule is created by starting with an 8% expected return and then deducting 2% for inflation, 1% for market volatility, 1% for the impacts of negative dollar cost averaging, and 1% as a comfortable margin of safety. In plain English, what this means is that if you can live off 3% of your investable net worth every year before considering taxes, congratulations, you are financially independent and you will continue to be into eternity, all other things being equal. But 3% is not huge. If you wanted to live off $100,000 per year, you would need $3.3 million invested. There are some people that will push this 3% rule to a 4% rule to be a little riskier but retire a little sooner, but the fact of the matter is, to pull something like this off, you still need to be pretty damn rich. The idea that anyone can do this is simply not true, but it might still be less daunting than these numbers would suggest, and in fact, there are even tiers of the FIRE movement to account for this. So, how could an average person stop working forever? While making enough money to live forever on $100,000 a year might sound almost impossible, many pundits of the movement argue that this is far from necessary, and in fact FIRE is more about assessing what you value rather than earning lots of money. If you value material things and want to be able to go on multiple holidays per year to exotic destinations, that's fine, but you are going to have to give up a little bit more of your time and spend slightly longer in a career building up an investment portfolio, if you ever want to retire. Other people might be perfectly content to live in a low cost of living area and pursue low cost hobbies, which means that they will need far less money to be financially independent. What this effectively means is that how quickly you can retire is determined by your savings rate rather than your gross savings. A nurse earning $60,000 per year after taxes and living on $30,000 per year should be able to retire within 16 years at a 3% safe withdrawal rate. A neurosurgeon, on the other hand, might be earning $500,000 per year after taxes, but after an expensive mortgage, private school fees, exotic holidays, and student loans, they might end up spending $400,000 per year on their living expenses. What this means is that it would take that doctor 28 years to get to a point where they could maintain their lifestyle indefinitely off their investments. Now, both of these instances are the result of personal choice. If the neurosurgeon loves his job and loves his nice things, then, well, all power to them. But if they don't like their job, the FIRE movement advocates for properly assessing if you like that new Porsche as much as you dislike 6 months at work. Now, of course, for some people, this math simply doesn't work. You can only lower your living expenses so far before you push yourself into poverty, and unfortunately, the reality is today that a lot of people out there can't afford even a basic lifestyle while still having money left over to save. But for those who can, it's extremely important to think about major financial decisions in terms of opportunity costs, with the missed opportunity being years that you could have spent sleeping in, working on hobbies, or travelling, rather than sitting in an office. Now, this is all well and good individually, but on a macroeconomic level, if this idea was to really take off, surely it's not sustainable. How would a world without workers work? We have explored the labour market twice in the last 2 months, and both times we have found that human labour is very important to maintaining a functioning economy, not to mention a functioning society. This shouldn't be a huge surprise to anybody, least of all of the people who sit down to watch videos on economics. But what might surprise you is that there could be an alternative. Consider this thought experiment. Someone is working and saving half of their income. With all of that saved money, they buy a farm, and then they pay to have a workshop put on that farm, and then they pay to have machines automate the planting and harvesting of crops. They also pay to have a mine with access to basic materials set up, and robots to harvest and refine those metals as well. Finally, their workshop is kitted out in all of the latest technology to allow them to produce anything their little heart desires from scratch. Well, in this example, this person would be completely financially independent, assuming they don't have to pay land taxes. Now, this hypothetical is sure to make a lot of ranchers and off-the-grid folks very excited, but it's not too different from what FIRE practitioners are doing. All of the things our hypothetical worker bought were either land or capital goods, as in machinery or technology that makes making stuff possible. Now, in this very direct example, this individual was investing in things that could be used to produce goods and services for themselves. But more realistically, a real person would use their money to invest into things that would be used to produce goods and services for everybody. They would then charge everyone the rights to use their productive capacity in the form of profit, which they would then pay out to themselves as dividends and, in the real world, likely have a company acting to facilitate this. In a sense, financial independence is like crowdsourced off-the-grid independence, using financial instruments to make the process of living off machinery and land more efficient. So, would a mass uptake in FIRE practitioners ruin the economy? Well, short term, yes. The drop in consumer spending and rush to financial markets would cause a lot of volatility, but long term, it is theoretically possible. We have explored this idea before on the channel in an automated future where capital goods completely replace labour and the factors of production in our video on autonomy. I don't want to repeat too much of that here, but a takeaway was that this capital-intensive future could be a utopia, or it could be a complete disaster, depending on how this inevitable transition was handled. The financial independence, retire early movement is certainly not something that is going to be the right fit for everybody. For most people, the cuts to their lifestyle are just not worth the extra few years out of their careers. There is also, of course, the psychological aspect of not having anything to work towards. Go play a sandbox game with unlimited money hacks turned on and you get the idea of how quickly it can get pretty boring without some kind of challenge. There are theories and suggestions that go a long way to remedying some of these more psychological issues, but again, this is not our area of expertise here at Economics Explained. Instead, from a pragmatic economist point of view, the FIRE movement's biggest takeaway might be the lesson it gives us in the trade-off of time for stuff. If we start thinking about purchases in the form of how many hours you need to work to buy something, you might be less tempted to splurge. 70 hours of team meetings for that new iPhone, 30 hours working through Excel macros to pay for that new outfit, 10 lame excuses to your boss as to why you were late in order to buy that fancy dinner. Well, for some people, it's worth it. But for many people, it isn't. Now, for the people that don't think it's worth it, sometimes the daunting prospect of actually starting to invest is the only thing holding them back. Fortunately, this step can be made a lot easier with Acorns. Acorns is your all-in-one financial services app that makes investing as easy as spending. Every time you use your debit or credit card, you can set up Acorns to automatically round up your purchase to the nearest whole dollar and then auto-invest the difference for you right into your diversified portfolio. And the best part is, you don't have to be an economist like myself to get started. That's because Acorns does the investing work for you. Each portfolio has been constructed with ETFs managed by arguably the smartest money managers in the world, Vanguard and BlackRock, not to mention help from Nobel Prize-winning economist Dr. Harry Markowitz. Even better, the Acorns platform provides pre-built portfolios which you can adjust based on your risk tolerance. For example, if you're young and have many years before you reach retirement, you can select Acorns' aggressive portfolio, which consists entirely of equities. Or, if you're a bit older and looking to de-risk your holdings, you can select Acorns' conservative portfolio, which is entirely comprised of short-term government bonds. Whatever your financial goals are, Acorns can help you get there. And that's why we here at Economics Explained, as well as 7 million other users, trust Acorns to manage our investments and savings. We'd be remiss if we didn't mention the power of compound interest, or the eighth wonder of the world, as Einstein once said. Consider this: the average Acorns user invests more than $30 a month using roundups, or about $360 per year. Now let's assume that you're 25 years old at the time of watching this video and you're finally ready to commit to becoming a long-term investor. By setting aside just $30 a month from your roundups into your diversified Acorns portfolio, which for this hypothetical example grows at 7% a year, you'd have a whopping $79,406.91 by the time you reach retirement at age 65. That's extremely impressive for spare change that you probably won't even realise is missing. Here's something else even more mind-blowing. You can accelerate the wonders of compound interest by using a tool like Acorns' automatic recurring contributions feature. By investing just an extra $10 a day into this hypothetical portfolio, you'd have a whopping $873,476.02 by the time you retire at age 65. If you're thinking now, well, that's all great, Mr. Economics Explained, but I'm not 25 and I don't have 40 years to invest. Let this video now remind you of that ancient Chinese proverb: the best time to plant a tree was 20 years ago, the second best time is now. Guys, never forget, every oak tree begins as a humble acorn. And you can start planting your financial oak tree today with Acorns. Sign up now at acorns.com/EE and they'll deposit $5 into your portfolio to help you get started with investing. That's acorns.com/EE. The link is on the screen now and in the video description below. Thanks for watching, guys. Bye.